All right, welcome back, Forexia family. This is the second video of this series. And in this video, we're going to go over exactly what we have on the screen right now. We're going to go over some more of the Forex basics briefly. We're going to go over the session timing, session bot, daily structure, some examples. We'll have the history of manipulation, the Bank of International Settlements. We'll go over that. We'll go over market makers, liquidity, etc. Manipulation basics, M and W reversal mastery, stop hunting and liquidity grabs. We'll go over candlestick anatomy, V2. We're going to go over stop hunting examples and the highs and lows and their importance. So, first of all, Forex trading basics number 2. We're going over the spread and manipulation of spread, some basic chart patterns, Forex breakout patterns, reverse price action briefing, and we're going to go over the average daily range. All right, spread basics. So a spread refers to the different all right. A spread refers to the difference between two prices, rates, or yields. A spread is the commission for trading, the broker's reward. The spread can be manipulated. So here is an example of the spread. We have the buy price and we have the sell price, and the difference between the buy and the sell price is the spread. Spread manipulation. When is the spread manipulated? The spread can be manipulated during high impact news events, right before session change, during session change, at the start of the week when everyone is trading and when everyone starts to trade, open market Sunday. A lot of times the spread is very volatile or very manipulated. Right before a big move is made, the spread a lot of times is manipulated as well, and the spread can be used to take out your stop loss without the price ever reaching your stop loss level. So the market or the price doesn't have to reach your stop loss level. As long as the spread reaches that level, it's enough to take out your stop loss. So that's why spread manipulation can be so deadly, and why we have to take into consideration the manipulation of spread. All right, some basic chart patterns. A simple Google search will yield this type of result. This is the strategy most beginner traders believe will make them millions, right? You start trading Forex, you Google chart patterns or strategies, and these are the basic patterns that you find on the first page of Google, and this is what everybody thinks is going to make them a lot of money, right? We have continuation patterns, we have reversal patterns, we have the wedges, we have the pendants, we have the flags, all of this mumbo jumbo for beginners to make them believe that this is just as easy as finding a little pattern and continuing that pattern, right? So Forex breakout patterns. Here we have an example of a lot of the different breakout patterns. Patterns are used to induce market participants and generate liquidity. There's no logic behind why except the pattern itself. Reverse price action briefing. So I have coined the term reverse price action. It's basically when you reverse engineer price action, questioning why the pattern exists, questioning how market participants react under the given circumstances of these patterns, question what is happening at the given moment, and project and emotional bias of how both market participants will react to this given pattern. So, reverse price action briefing. Here we can, describe what we see. We see what looks like a market pushing upwards and then consolidating into a wedge. So, describe the mainstream retail trader thought process in the situation. Well, what we might think is going to happen is we're going to see a breakout of this wedge, and then the retail trader, or the mainstream 90% of traders, will believe that upon this breakout, we'll just follow the breakout in whichever direction it goes. So here we can see we have a breakout to the high. So what will a lot of the mainstream retail traders be doing? They'll be buying once the breakout breaks past this previous high, because, well, what would this be? This would be a high, we have a low, we have a lower high, and then we would have a higher high after this breakout. So that would be the characteristic of an uptrend. The characteristic of an uptrend, right, is the creation of higher highs and higher lows. That's exactly what we have. So this would be inducing retail traders to buy into this current market because of these circumstances. So that is how we just described that the retail trader would think in this given situation. Now describe how smart money might think or process this situation here. Well, this is exactly how smart money would process this. We see an induction of retail traders buying into what they think is going to be the continuation of an uptrend. What would be the smart thing to do if you were the one manipulating the market? Well, smart money would completely reverse the market off of this scenario here. That is how smart money would make money, and that is how what happens in a lot of these situations where we see these reverse price action patterns playing out. All right, the average daily range, or ADR. The ADR is the amount a pair can move per day based on past history. Each pair has a different ADR. ADR calculators exist and can help calculate this. However, it is not necessary. ADR differs depending on the time range you are measuring. ADR helps give an understanding of how much range you have to work with in one direction before the reversal happens. All right, so the ADR, or the average daily range, is just the range between the high and the low in any given day. So in this example, we have one day, and we have obviously the high right here, and then we have the low. So this is the daily range of this one day. We have the start of the day right here, this blue line, blue checkered line, dotted line, and then we have another blue dotted line marking the end of the day. So that is a 24-hour period, the highs and the lows. Let's say this daily range is 100 pips, from the high to the low. On average, over the past few days, this daily range on any given pair, let's just say it is 100 pips as our example. So if we were trading Asian session, and we know Asian session is mostly consolidation here, so we can see consolidation kind of moving downwards, and then we see London session opens with a spike to the low and then comes up and makes a new high of the day. So from this low to this high, we have 90 pips. If the average daily range is 100 pips, what could we expect? We could expect, if price moves up 10 more pips, we could say, all right, price has met the average daily range, and it probably won't move any further in any given direction to the upside or the downside, because that would widen the 100 pip range. And on average, this daily range is no more than 100 pips. So here we have this example where we have Asian session, London session breaks the low, then breaks back to the high, and we can see this overall 100 pips has been met for the daily range. What happens now is that we can expect a reversal off of that range, off of that, the low and the high. We can expect a reversal off of this high, and for price not to keep moving upwards because it has exhausted, it has met the expectation of the 100 pips that it usually moves any given day. All right, moving on to sessions and timing. So we have multiple sessions in Forex, and we're going to be going over just the three main sessions. So the three main sessions that I like to go over with my students are Asian session, and then we have London session, and then we have New York session. So this makes up a 24-hour period any given day. And in order to find these sessions on our chart, I have a very, very simple way to find these sessions. Because if we're talking about how everybody lives in different parts of the world and we have to find which time zone everybody's in, that will just make everything super complicated. Okay? I have an extremely easy way for you guys to understand exactly which session you are in. It is using TradingView. So if we go into TradingView and we go into session and timing, and I believe this may have been moved, so this might not be an appearance anymore. It might be under like a different setting, but it's still in TradingView settings. So look around in the settings and try and find. It might still be under appearance. I might be mistaken about that. But try and find the setting that says session breaks. And you're going to want to check this little session breaks. And I like to keep it on blue, and I like to have it as a dotted line. So just copy those settings into your TradingView. And this is how it should look. So Asian session should start, and you should have a blue dotted line at the start of Asian session. Now, if we look back here, we see I have 10 hours after Asian session equals London session, and then I have New York session equals 5 hours after London session. So what does that mean, looking back at this? If we go back to here, we have the Asian session. We can say at the start of this picture is the start of Asian session, and then Asian session lasts about 10 hours. 10 hours into Asian session is the start of, what was it? London session here. 10 hours after Asian session is London session. So all you have to do is mark 10 hours after the start of Asian session, and we know Asian session starts because there's a blue dotted session break line. So once we see that, and this isn't it, this blue dotted line, just ignore that blue dotted line for now. Just imagine right where this image cuts off right here, there's a blue dotted line, and we draw out 10 hours from there. We can see exactly right here is London session. And we can see exactly at the start of London session here, there's a characteristic where there's a more volatility. We see this big fat red candlestick pushing down here for London session. There's a lot more volatility come start of London session. Boom. Now, if we count 5 more hours after London session, boom, we get to New York session. So from the start right here of, this is the start of the day Asian session, to London session is 10 hours, and the start of Asian session to New York session is a total of 15 hours. So 5 hours from London to New York, and 15 hours from start of Asian to New York. Why is this important? Well, because these sessions have specific characteristics that we're going to need to understand coming into these future lessons. Asian session is the consolidation session, where we can expect multiple hours of relentless consolidation, where the market is basically in a range, a very tight range, and it is very bad for trading. At least in my strategy, I like a more volatile market. I like it when the market moves. I like it when I can catch the market moves before they happen. And I like it when the market is moving hundreds of pips and not just a few pips in a matter of a few hours. So Asian session is consolidation, where the market moves very little bit. London session characteristic is the breakout or the induction, which if we understand, London session is after Asian session. So if Asian session is the consolidation, then we have after the Asian consolidation, we have the London session, which is the breakout of that consolidation. Okay? Then, after that breakout, come 5 hours later, we have the New York session reversal. So these are the 3 characteristics for the 3 main sessions. Take notes, write this down where you guys need to. Asian session. Asian session lasts anywhere from 10 to 15 hours of consolidation. If you don't understand Asian session when it happens and that it is relentless consolidation, it will drive you crazy. Okay? If you just put some buys in because you think there's a support level, well, the market is probably not going to move until you go to sleep. And then when you go to sleep, you're going to wake up probably with your stop loss hit, just because this is how the market is designed. So Asian session, consolidation, it'll drive you crazy. London session, we have 5 hours of manipulation and inductions coming out of that consolidation. A lot of times London session will fill this average daily range, where it will spike to the lows, create the low of the day, then rebound off that low of the day, spike to the highs, create the high of the day, and then come off of that high of the day. And then that, a lot of times, will be the filling of that average daily range. Now, New York session. New York session, a lot of times, is the reversal session. We'll see a quick burst to end the day, and then we'll see a reversal off of the highs or the lows come New York session. Here we have the session characteristics lined out on our chart, highlighted for you guys to see. In red, we have the consolidation. This is 10 hours of consolidation right here. Actually, it's about maybe 9 hours of consolidation. And then an hour before London breakout, we have this breakout to the highs. Break outside of this consolidation, we can see this red box consolidation. We're breaking out, and then right here we have this candlestick come 10 hours in. What does that mark? It marks London. So London session, the characteristic of London session is the breakout. The breakout or the induction. Then we can see it breaks out past these highs and then reverses come London session. Come London session, it actually makes the high of the day and the low of the day. And then 5 hours after London session, we have the end of London session come New York session. New York session, they have what looks to be the low, right around the low of the day, and then a reversal off of that low for the New York session reversal comes all the way back up to the highs of right around London Asian session. So we have consolidation for Asian session, characteristic of consolidation, the breakout induction 10 hours in, London session, and then New York, we have the 15 hours in, we have that reversal off of the lows. We're going to see this over and over and over. Before we jump into it, and before we start looking at more examples of this, I want you guys to see the problem reaction solution here. So I am basically the only one on the internet that has coined this problem reaction solution, Hegelian dialectic, intertwined it into the Forex world. So I believe, it is my belief that the Forex market is nothing more than manipulation, mind games, and overall the manipulation of masses and how people think. And if you know anything about Hegelian dialectic, that's what Hegelian dialectic is. It's basically a form of mind control, and it has a three-part series of this kind of mind control, which it starts with a problem, it has a reaction to that problem, and then there is a predetermined solution to that problem after the reaction. So the Forexia session bot in Telegram, this bot is actually offline right now. I'm working on it right now to get it back online. This session bot helps you guys understand when the sessions are changing. So it gives daily notifications, it gives the best times to trade, gives notifications upon session changes, and it also notifies full and new moon cycles. All right, ADR plus session timing. If the ADR, or average daily range, is exceeded in London session, there's a high chance of a reversal for New York session. This can be used to help project the future of price and also predict reversal timing. Daily structure. Some daily structure features. We have the daily open, the daily close, the high of the day, the low of the day. We have three main sessions, and then we have the consolidation, or aka Asian session. Alrighty. Now this looks like we're going over a little bit more of the anatomy of the candlestick. But here, we're including the anatomy of the candlestick with Asian session, London session, and New York session. So we're just including the sessions here. So once again, we have this is the same structure, but if we include the sessions, we have Asian session, London session, and then New York session. So Asian session, market opens, we have what am I doing? Mainly consolidation. We have mainly consolidation. I'm sorry, I'm tripping on my words here. Mainly consolidation after market opens, and then come spike to the low, come London session, break out of this consolidation, creates the low, 10 hours into the day, reverse off of that low, come and create the high of the day. So right around London session, we have the low of the day created, and the high of the day created. Then we work off of that high of the day, and then what do you know? We come 15 hours later, we come into New York session. New York session, we have that candlestick pattern, railroad candlestick pattern off of the high of the day. And what is the New York session characteristic? It is a reversal. So we have the reversal off of the high of London session, and then we close the day right here. So once again, Asian session consolidation, breakout to the low, move to the high, consolidation, a little bit of consolidation into London session, and then breakout, reversal, New York session. So we're going to go over a little bit of a history of manipulation. All central banks are owned and controlled by a single family. All central banks are controlled by a single bank, in case you didn't know that as well. It's called the Bank of International Settlements. It is a shadow bank for the elite. History of manipulation. So, I don't know if I'm going to be able to show it in this video, but there is a news video where basically there's a bunch of news anchors talking about there's a video where basically it shows that news is scripted. All news is scripted, and it is a video of all of these news anchors saying the exact same thing. So just look up video threat to our democracy. I'm sure you'll find it. Maybe I'll throw it in here at the end. And why did I want to make this point? Well, it's just to show you guys that not only is the news manipulated, if the news that we see on a daily basis is as manipulated as this, and it works off of a script, wouldn't you think that the world's largest financial market might just be manipulated as well, and they might be working off of some sort of script? Well, that's what we're revealing in this video. Manipulation basics. Support and resistance is nothing more than a template for market manipulation. Mainstream will always be manipulated by smart money. So here are the universal basics of support and resistance. We see a support or resistance line, and we see price breaking through. Oh, that's a buy. Vice versa, if we see a support or resistance and price breaking through that, oh, it must be a sell. The most time price spends on or near a trend line or support and resistance level, the stronger the level becomes. How many times have you guys heard that? How many times has your little mentor, some dude on Google that you just found by typing in how to trade, how many times have they told you that the more time price spends on a trend line, or the more time it bounces off of the support level, the stronger the level becomes? We've all heard that before. Or another one, another great BS method. 3 touches to a trend line validates the setup. We have all heard that in our trading career. Okay, whether you just started trading yesterday or whether you're a veteran trader that has been trading for the past 10 years, we've all heard everybody say this. 3 touches to a trend line validates the setup, or the stronger the trend line is because the more times price touches that line. Okay, that is the biggest BS that you guys will find. The industry keeps trying to perpetuate this bullshit lie. this is what it looks like, and then this is what happens in reality. We have, oh, strong support, looks like it worked out, and then we're coming back again, strong support, and then what happens? Boom, breaks through that support, induces everybody to start selling, hits the stop losses of traders that bought here and had their stop losses down here, and then reverses the market. So this is what I was saying when I explained that support and resistance is nothing more than a template for market manipulation. So, once again, price comes down, starts bouncing off of this line. Once again, there's not even a line here. They're making the perception, they're making you perceive a line here because the market comes and consolidates off of this area, bounces 3 times off this area. Oh, it must be a good time to buy. What happens? Breaks through that level, hits the stop losses of the buyers because buyers that are buying in here are most likely going to have their stop losses below this level, and then completely reverses against those traders. We have to understand that orders are liquidity. So there are multiple different types of orders. There are, apart from stop loss orders, right, where we saw here, we're looking at potential stop losses under this level where buyers are going to be accumulating buys. We could also think of orders as liquidity, where buy stops, pending limit orders, or pending stop orders, whether it be in the form of buy orders or sell orders, these limit and stop orders are liquidity. So when there's a massive amount of orders in any specific area of the chart, that's where there's going to be a lot of liquidity, and that's where price is going to target. So in this previous example, a lot of traders are going to be buying off of this supposed support. A large sum of buyer stop losses are going to be accumulated at this level, under this supposed support. What is going to happen? What would be the obvious case here? That price is going to break through this obvious support and then reach down and grab all of this liquidity in the form of stop losses, stopping out all of those traders, taking their money and then moving in that intended direction. So, support and resistance basics. We have a few touches to the trend line here. 1, 2, 3. And it looks like that third tap to that trend line validates it, right? Makes it pretty strong. Then we're coming up to a fourth tap in this trend line. God forbid it doesn't just drop down here, right? Of course, that's what's going to happen, right? Well, let's zoom in a little bit. Oh, what do you know? Instead of just bouncing off of this trend line and moving down, making another low, another lower low, and following that downtrend, what happens? It looks like they're taking their time, respecting this trend line. In reality, they're giving you time to sell. They're giving everybody that sees this as much time to sell as they want. They're making them believe that this trend line, because it was tapped here, 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 and now multiple times here, that it is very strong, right? You might as well sell here because that's an obvious sell, right? I'm going to be rich. That's what everybody thinks. Boom. Why is the market doing this to me? Please give me another chance. Oh, the market is stalling off of the resistance, right? We see this confluence here where we have the the resistance level, previously hit resistance. We're coming back to this previously hit resistance level. What could happen? Well, I will sell again here to have a better position. Boom! I lost all my money. This is, how many times have this happened to you guys? Okay, I know this has happened to me multiple times before I could understand why the heck this happens. But now, when you understand that this is all designed to do this to you, that in reality, it's not actually stronger the more that the price taps your invisible line, that actually doesn't make your invisible line any stronger. It's actually more of just a way to manipulate you into doing something stupid, basically. M and W reversal patterns. What to look for. We want to look for highs and lows, session timing, New York and London session. The second leg of the M or the W will be more volatile. We'll get into that. I will make sure you guys understand what that means. News-induced second leg. What could that possibly mean as well? And micro and macro time frames. So we're going to go over all of this. Here we have the daily structure plus the sessions plotted out. Right here we have the start of the day. We have the end of the day marked in these blue lines. Then we have 10 hours in consolidation. And then right with this red line, we have London session. What do we have London session? Normally, it is the breakout or the induction. We can see the breakout of consolidation. We have a little M formation off the high, come down. 5 hours later, we're looking at New York session, W formation off the low. And then we end the day in consolidation to start the next day in consolidation. And if we look here, this just represents a example of a real data that we have on our chart right here for GBP USD. I believe this is the 15-minute time frame. We have 10 hours of basically consolidation. The market comes to break out of this consolidation, break out to the highs, form a little M formation off of the high, and then comes back down to these lows. New York session kicks in 5 hours after London session, and we have the low of the day being made, a W formation off of that low of the day, and then retraces off the low of the day and kind of ends the day in consolidation here. So 1 M and 1 W per day is possible. It is very possible to have an M and a W every single day. Okay? Sometimes there's not a W, sometimes there's not an M, sometimes there's only an M, sometimes there's only a W. Sometimes it's just a spike and it doesn't even look like an M. Sometimes it's just a spike and it doesn't even look like a W. But we will go over this and learn how to comprehend these different patterns. So there is an infinite array of different variations of these M's and W's or structures. The direction of the breakout or fake out of Asian session consolidation many times can help as confirmation to project the outcome of the next session. So here we have some examples of this M and W formations come any given day. So this is a 15-minute time frame right here, and we have the start. We have this blue dotted line right here. This is the start of Asian session. 10 hours later, looks like right around here would be that breakout of this consolidation area. And this right here would be the first leg of this M. And then the second leg of the M. So this is a big, huge, fat M right here, but it still looks like an M. Okay, I would still call this an M. Now right here, we come back to New York session. It looks like this is New York session right around here. And it looks like we have the first leg of the W, and then comes up, and then that second leg of the W right down here to draw any liquidity off of the low of the day for the second leg, and then retrace back up and end the day in consolidation. Once again, we have another, what looks to be an M, but the second leg extends a little bit higher off of this first leg. So M formation off the high, then W formation off of the low, ending the day in consolidation. Once again, the day will always begin in consolidation and end in consolidation. The M's and W's, you guys can make them, draw them out however you wish. So here we have consolidation. We have that blue line. Once again, right here, it's almost cut off, but we can barely see it. And then we can see consolidation. And we come spike to the high of the day, create the high of the day, and then what looks like a wick right here. This could be considered the second leg of that M. Boom. To reverse the market, and then it looks like we have 5 hours have passed, and then right here would be New York session. It's New York session, a little micro W formation formed right here for a reversal off of the low of the day and a complete reversal of this pair. Here we have the highlighted Asian session consolidation, 10 plus hours of consolidation. Then we can see right around here, London session started. We have the breakout of London session, and then that M formation where the second leg would be this wick, right? And once again, we said the wicks are, a lot of times, we use these as our confirmation or candlestick entry pattern. M formation, and then right after London session, 5 hours after, we have New York session. W formation off of the low to reverse, completely reverse the market. All right, so here we have an M formation once again, where we have a big first leg come up of this M, and then this would be the second leg of the M. And we can see right here, it comes up and completely drops. And if we have, this would be the start of the day, 10 hours in consolidation, right? And right around here would be London session. I wouldn't be surprised that this spike to the highs here is London session, induction, breakout of this consolidation for Asian session, and we can see they're meeting or reaching to the high of this previous day. All right, we're looking at USD/JPY 15-minute time frame. London session started 1 hour ago. We have a 200 pips range already. And here are some notes. ADR has been exceeded. London session still has 4 hours left. Wow. Okay, so ADR has been exceeded, but London session still has 4 hours left. All of New York session yet. I'm not sure. Not sure what I was supposed to be saying there. Asian session used to pump the ADR. Okay, so Asian session was used. It looks like this could have been Asian session, so it looks like it wasn't in a consolidation. It looks like it was more used to pump that ADR. What could our next move be? Our next move is to expect New York session to stop hunt London session high before a slow reversal. Why? Well, most likely the ADR has been met. Okay? We have a massive pump here, and we still have a few hours left into London session. So expect New York session to stop hunt London high before a slow reversal. So here we have, once again, a little bit better picture of it. ADR plus session plus M, high of the day combo. So this is what we could maybe expect for after London session. New York session, spike to the high, but not go. We wouldn't expect this to keep pumping and making new highs, right? Why is that? Because we've already exceeded our average daily range. London session has a few hours left, and then New York session, what could we expect? Well, New York session, a lot of times the characteristic of New York session is the reversal, so we could maybe expect an M formation off of the highs here, and then reversal off of these highs. And what do you know? We get exactly that, where the price came up to create that M formation off of the high, and then reverse off of that high, and then end the day in consolidation. All right, so next we have inductions. Support and resistance is a manipulation template. All right, I'm just seeing how many slides we have left until the end of this video. All right, inductions. We already kind of went over this. So, macro setup. In Forex, we have micro and we have macro. So there are different time frames. We can look closer at what the market is doing, or we can zoom out and look at a higher time frame or a macro time frame and look what the market is doing. Just like how we have these different time frames of micro and macro, we have micro and macro patterns or setups. So here we have what looks to be a consolidation, and then we have a breakout or induction, breakout of that consolidation past the previous low, which would be inducing sellers to sell, and in combination with the 1.18 psychological number, right? So we can expect a lot of volatility, a lot of liquidity at this area. These two candlesticks close, and what can you see? We can see a candlestick formation of a confirming candlestick formation that this could potentially reverse off of this low, off of this previous low. And what do we see? The price completely reverses off that previous low. If we zoom in a little bit more, so once again, this looks like a 4-hour chart. And then if we zoom into the 15-minute chart, we have, or maybe this is the 1-hour time frame. Yep, this could be the 4-hour time frame, and this is the 1-hour time frame. We see Monday, Tuesday, Wednesday, Thursday. Thursday, they break out of this overall larger consolidation, break out past the low of the week, creating a new low of the week, and then that W formation out of this induction, inducing the sells, W formation, and then right off of this psychological 1.18 level, and then a reversal, completely making new highs. Inductions, stop hunting, and liquidity grabs. So here, once again, we have a pretty obvious trend right here. and this is what I mean, that a support and resistance is nothing more than a manipulation template. So we would maybe put a support level right here where this black dotted line is, and our resistance level right here, because we can see that market is in consolidation at these levels. But it's also looks like it's in a trend, okay? Before this massive spike up and this reversal, we saw a spike down, breaking out and past this support level. So this was once a big fat red candle all the way down here, inducing sellers. This as well, this star formation right here was another big fat red candle reaching way down here at this point, at one point, inducing sellers. After seeing all of this, they would have been induced to sell, and then what happens? Boom, in one candlestick, all of their stop losses were hit. One more candlestick induces buyers, and then a complete reversal of this trend. So we can see, just by the use of a few support and resistance lines and the trend lines, they were able to completely manipulate by inducing first to the lows, breaking out of this support, and then inducing to the highs, breaking past this resistance level. We can see they were able to completely manipulate a lot of the traders that were in this price range. All right, Forexia fam, it looks like we have ended this video, and we're going on to the next one of this series, okay? The next one in the series is going to be backtesting, the importance of backtesting, tools for backtesting, and what to study when backtesting. Maybe. We might cut this out.